I'm Lloyd Holliday, and this is the Cost of a Thing podcast. Thanks for listening in today. The cost of a thing is the amount of time that you must spend working to buy the things that you want and need. And that directly determines your standard of living. And the American standard of living is what this podcast is all about. And I'm going to be discussing anything that affects that standard of living, especially those things that affect it negatively. And especially those things that have lowered our standard of living from the one that we had in America here in the 1960s, which was better than the one today. And why am I doing this, talking about our standard of living? Because I've been there when it was better than it is now. I've seen how it was in the 1960s and 70s, and it was better in general for more people. And I don't see the government talking about this, trying to improve the standard of living. I don't see the media talking about this. It's either ignored or it's forgotten, and it may be purposely ignored. So that's why I want to bring these things out. I want to bring attention to the fact that our standard of living has gone down and is going down. And that's what I'm going to talk about right here on the Cost of a Thing podcasts. Okay, today I'm going to do an add-on to the stock market super ripoff that I did last week. That was podcast number 22. And that was number 10 of my top 10 super ripoffs that are lowering our standard of living over the past 50 years. So I guess I'll just call this part 2 of the stock market super ripoff. I thought of a couple of more things to talk about on that. I'm just going to add that in here. And especially in light of the Federal Reserve interest rate cut of 0.25% on Wednesday. So I'm going to talk about how that fits in to the stock market super ripoff. The stock market, I talked about it being in this huge bubble, and it's overpriced, and it's being propped up, and someone might ask the question, well, then why do all these smart bankers and investors and all these other people, why are they putting their money into this stock market that's propped up and obviously 4 or 5 times its real value in a historical sense? Okay, now why do they do it? Because they know the government has their back. They know that the government is not going to let that general stock market index or one of those stock market indexes go down. Not for very long. They're going to step in with the things I said in my original stock market ripoff video, podcast 22. More lower interest rates, more QE, and the other things. And this backstopping of the stock market by the government and the Federal Reserve, which is part of the government, is not just implied anymore. Okay, for a while it was implied, and there was a little worry that they wouldn't step in and they let it fall. And, that's how it went in 2008 for a while. But then, that was an implied, there was an implied guarantee of the stock market back then. But now, since 2008, these investors, these bankers, these corporations, they know that there is a government guarantee. The government is going to have their back. They're going to make that stock market go up. It's not going to go down. This is an explicit. See, it used to be implied, but now, since 2008 and everything that's happened after that, it's an explicit guarantee. The Federal Reserve has said that they are going to keep that stock market high. And that is what they're going to do, and that's why these investors get in there. They're not worried about losing their money, as they really should be in a normal stock market where the government is not manipulating it and propping it. So you've got all these corporations buying back their stock and driving these prices higher. Well, they know that the government is going to keep that stock going higher. It might go down for a little bit until the government gets in there and manipulates it back up. But it doesn't go down very far before it's back up to record highs. And there's been hundreds of record highs on these stock indexes in the United States and most of the ones overseas. The central banks are propping them up too. So there's always a record high, and they're just celebrating that like it's the greatest economy ever. It's not. It's just the government is propping those stock markets, and the investors know it, and they're very happy about it. And except for maybe a lone stock, some company that goes out of business, there is still some risk of a single stock that it might go down. But the majority of the indexes and the big companies, I mean, we've seen the bailouts, we've seen the low interest rates that allow these companies to buy their stock back. We've seen the QE 1, 2, and 3, and then the central banks overseas are still doing QE. That's how they're propping them, and that's how they're going to keep doing it. And the investors know that. They have no worries. They don't really care. They just keep putting money into it because it keeps going up, and they know the government's going to keep it going up. And as a perfect example of this, I wanted to bring this out because on Wednesday this week, the Federal Reserve cut interest rates 0.25% down to about 1.5%, 2%, somewhere in that range, almost zero. It's been almost zero for like 10 years now. I mean, for all practical purpose, 1.5% is zero, I mean, in my opinion. And why did they do it? Because around January, early January of 2019, there was a big sell-off in the market and the stock markets, and the prices went down quite a bit, a few thousand points, and which isn't even that much at this point when the thing is at 20, the Dow Jones is at 26, 27,000, somewhere in there. But it was going down. So the Federal Reserve had to come out and say, the reason the stock market was doing that first is because the Federal Reserve had been raising rates up, and it got up to like 2.5% or something like that, somewhere in the 2.5% range. And the stock market was afraid that they were going to keep raising those rates. So they started selling stocks, and the market went down, this big dramatic upheaval there. Kind of like a hissy fit almost. I think that's a good word for it. Stock market didn't like, the people in the stock market, the investors, quote investors, didn't like the interest rates going up. So they started to complain, and we're going to sell our stock and make the stock market go down and, bring the economy down and all this other, the things that go with that. So the Federal Reserve came out after that or around that time and said, no, well, wait a minute, we're going to look at this, and we don't want to raise rates too high. So they talked about they were going to stop raising rates and maybe even lower rates, and that satisfied the stock market. So it started to go up again. And there it is. There is a perfect example of the explicit guarantee of the federal government that the stock market, if it starts going down, they're going to lower interest rates. They're going to do whatever it takes to keep that thing going up. And that's what I'm talking about here. So that was a perfect example on Wednesday of how the Federal Reserve and the government are propping up that stock market. And the investors know it. They know they're going to do it. And all they got to do is protest a little bit by selling a few stocks and dropping the price a little bit. Federal Reserve gets all flustered and worried, and they get in there and they start lowering rates again, and they'll do whatever it takes to keep that stock market high. Whatever it takes. I'm convinced of that. So there it is. There's the explicit guarantee. Your stocks will never go down. The stock indexes will never go down as long as that Federal Reserve is there to ride in on their white horse and prop it back up and keep it stable and going higher. And the investors know this, and that, like I said, is a perfect example of what I was talking about that explicit guarantee, of the manipulation, just sheer manipulation. And I think it's corruption. I mean, people would go to jail for this in the past, but now it's just normal behavior. We're going to prop up the stock market. We'll tell you. They'll tell you they're going to prop up the stock market, and they get away with it. So, it's not the stock market of the past that was based on the real economy, and it could go up or down depending on how the economy was doing. It just always keeps going up, and the Federal Reserve's main job is to keep that stock market stable and going higher, and they are doing it. They did it on Wednesday, and the stock market likes that, and that'll probably drive it higher. So the quote investors don't have to worry about anything. They just sit back now and wait for the Federal Reserve to prop and pump that stock market higher, and just collect that free money. It'll be rolling in, and they don't have to do anything for it. It's just coming to them like a river flows into the ocean. It has no worries by the investors. It's a sure thing. It's like a gambling casino where all the games are rigged in the favor of the investor. Okay, I'm going to wrap up this podcast about how the investors in the stock market know that it's a sure thing, even though priced many times higher than its real value. That's all made possible by that explicit guarantee by the government and the actions to back that up, just like the Federal Reserve did on Wednesday with that 1/4 point interest rate cut. And as big as a bubble as the stock market is currently in, if the investors, the bankers, the corporations had one tiny doubt about that explicit government guarantee that the government is going to keep that stock market stable and rising, they would run for the exits like 10,000 cockroaches when the lights get turned on. There would be absolute panic, and the stock market would return to its real value very quickly. Thank you for listening in today, and until next time, this is Lloyd Holliday signing off.